The American Civil War was fought and won on the battlefield at Appomattox. It ended with the surrender of Robert E. Lee and the emancipation of 4 million people. The military, political, and moral narrative is settled. But the story of the financial war, a war fought in the banking halls of London, Amsterdam, and Paris, is often forgotten. This war had no cannons or cavalry, but its casualties were measured in ruined fortunes, national humiliation, and the long-term strangulation of the American South. To finance its bid for independence, the Confederate States of America issued a revolutionary bond, the Cotton Bond, a financial instrument backed not by gold or government revenue, but by the world's most desired commodity, king cotton. They sold these bonds overwhelmingly to European investors, promising a guaranteed supply of the white gold that drove the global industrial revolution. When the Confederacy fell, its debt, hundreds of millions of dollars owed primarily to European middle-class investors and institutions, was repudiated, rendered worthless overnight. What followed was a financial shockwave that devastated European capital, crippled the South's ability to rebuild, and entangled the United States government in a decades-long international financial controversy. The refusal to pay was not just an act of economic destruction. It was a final, brutal act of sovereignty that defined the financial landscape of the post-war South for generations. This is the story of how the economic promises of secession became the debt of defeat, and how the financial collapse shaped the very contours of Reconstruction. 1. The weaponization of King Cotton. The Confederacy's gamble. Cotton is king. In 1861, the newly formed Confederate States of America faced an existential problem: how to finance a massive, industrialized war machine against the manufacturing might of the Union. The Confederacy had almost no gold reserves, a tiny industrial base, and no international standing. Their solution was rooted in absolute certainty: King Cotton. The South believed with almost religious fervor that cotton, the commodity responsible for over half of all U.S. exports and the engine of Europe's textile mills, was a weapon more powerful than any army. They reasoned that a temporary embargo on cotton exports would force Britain and France, whose economies relied on southern cotton, to intervene militarily on behalf of the Confederacy. The Confederacy's financial mastermind, Secretary of the Treasury Christopher G. Meminger, decided to leverage this power directly by issuing a unique debt instrument, the Erlanger Loan, more popularly known as cotton bonds. The Erlanger Loan. The Erlanger Loan, issued in 1863, was an attempt to raise capital directly from European investors, bypassing skeptical American markets. It was a massive financial gamble. The collateral. The bonds were payable in either cash or, crucially, cotton. A bondholder could exchange their paper certificate for a guaranteed amount of cotton, deliverable at Confederate warehouses, at a price far below the prevailing market rate once the war ended. The promise. This was the crucial hook for European investors. Despite the war, the demand for cotton was so intense that the bonds offered a promise of massive, quick profit once the Union blockade was broken. They were betting on the Confederacy's victory in the subsequent explosion of cotton supply. The bonds were sold mainly in London and Paris, often through the financial house of Emil Erlanger and Co. The initial offering was highly successful, attracting capital not just from wealthy institutions, but from thousands of middle-class investors, doctors, retired clergy, small merchants, who saw the cotton bond as an easy, secure investment backed by an essential global commodity. They were betting on the stability of the cotton trade, unaware they were betting on the stability of a nation destined to fail. The Erlanger Loan raised over $15 million in immediate European capital, providing the Confederacy with the hard currency necessary to purchase ironclad warships, artillery, and vital military supplies from European manufacturers. The Confederacy had successfully commodified its most valuable asset and sold its future to European investors, but the value of that commodity was about to fall to zero. 2. The debt of defeat, from assets to ashes. The vice of the Union blockade. The Confederacy-S strategy was fatally flawed by the simple arithmetic of the Union-S naval blockade. The blockade, though leaky, tightened throughout the war, making it almost impossible to export cotton in bulk or import foreign goods. The cotton that was supposed to collateralize the bonds remained locked in warehouses in Charleston and Mobile, useless to the European creditors. The value of the cotton bonds became entirely dependent on Confederate military victory. When the Confederate armies lost, the financial market panicked. As Sherman marched through Georgia and Grant pressed Richmond, the market price of the cotton bonds plummeted. Investors who had bought at high premiums watched their paper wealth vaporize. The repudiation. The final financial death knell came not with the surrender at Appomattox, but with the U.S. Congress after the war. The U.S. government took the uncompromising stance that the Confederate States of America had never legally existed. It was merely an insurrectionary body. Therefore, the federal government was under no legal or moral obligation to assume the debts of the failed rebellion. The 14th Amendment to the U.S. Constitution, ratified in 1868, made this position explicit and final. Section 4 states, "But neither the United States nor any state shall assume or pay any debt or obligation incurred in aid of insurrection or rebellion against the United States, but all such debts, obligations, and claims shall be held illegal and void." This single constitutional provision legally repudiated the entire Confederate debt, including the vast holdings of the cotton bonds, wiping them off the financial map entirely. European devastation. The impact of this repudiation on Europe was immediate and devastating, far exceeding the damage inflicted by the collapse of many sovereign bonds in that era. British creditors, British investors, who had purchased the largest share of the bonds, were financially ruined. The repudiation delivered a severe blow to the reputation of American securities in general and caused several smaller, high-street European banks to collapse. The price of secession. The total loss to European capital was estimated to be in the hundreds of millions of dollars, a massive sum at the time. The financial fallout was a deep source of international resentment toward the U.S. government, which was seen as having ratified a deliberate act of theft against the foreign investors who had financially sustained the Confederacy. The Confederacy had used its financial instruments to wage war. The victorious Union used its constitutional authority to wage financial destruction. The war was over, but the financial aftershocks were just beginning to shape the landscape of Reconstruction. 3. The shadow of repudiation, financial strangling, the ghost of debt. The repudiation of Confederate debt created a long-term economic trauma that crippled the South's ability to rebuild. Without access to international capital and with its state governments stripped bare, the Southern economy was left to sink into poverty. Absence of capital. The memory of the massive, uncompensated loss meant that European capital markets, the lifeblood of infrastructure development in the 19th century, effectively boycotted the South for decades. Creditors refused to lend to the Southern states or to private enterprises there, viewing them as financially unstable and politically unreliable. State-level insolvency. Southern state governments, desperate for funds to build schools, bridges, and railroads, tried to issue new bonds. These were often trading at massive discounts, as low as 10 to 20 cents on the dollar, because investors feared future repudiation or simple non-payment. The Union had imposed military defeat. The financial market imposed capital starvation. The very structure needed for economic recovery, railroads, industry, modernized agriculture, could not be funded without the trust of international creditors, a trust that the cotton bond collapse had shattered. The rise of scalawag bonds, further complicating the South's financial trauma, was the problem of Reconstruction debt. Following the war, some newly formed Reconstruction state governments, often controlled by Republicans, and newly enfranchised black citizens, derisively called carpetbaggers and scalawags, issued large amounts of new bonds. Much of this debt was legitimate, used to finance desperately needed public works. However, some was fraudulent, the product of corruption. When the Democratic Party regained control of the state legislatures in the mid-1870s, the end of Reconstruction, they used the corruption as a pretext to repudiate this debt as well. The target. This time, the repudiation targeted bonds issued by the Reconstruction governments, further devastating the American and foreign investors who had finally begun to cautiously re-engage with the South. The politics. This second wave of repudiation served a dual political purpose. It cleared the state's books of debt and symbolically erased the entire political legitimacy of the Reconstruction era, appealing to the white electorate. The relentless pattern of repudiation, first the Confederate debt, then the Reconstruction debt, left the Southern economy in a state of perpetual financial distrust. The region became an isolated financial island, cut off from the global capital flows that were driving industrialization elsewhere in the U.S. and Europe. The cropline system. Cut off from formal bank lending, the Southern economy collapsed into a primitive, localized system of finance based on debt servitude. This was the notorious cropline system where small farmers, white and black, mortgaged their next harvest to local merchants in exchange for seed and supplies. This system was devastating. Perpetual debt, high interest rates, and fixed-price contracts ensured that farmers were almost always in debt, trapping them in an endless cycle of poverty. Monoculture. Merchants demanded that farmers grow only the most profitable cash crop, cotton, further solidifying the South's reliance on the very commodity that had led to its initial ruin. The financial aftershocks of the repudiated cotton bonds had, ironically, ensured that King Cotton still ruled the economic landscape of the South, not through wealth, but through the chains of debt. 4. The diplomatic stain, the legacy of non-payment. The cry of the creditors. The repudiation of the Confederate debt was not a clean break. It became a decades-long diplomatic and legal headache for the U.S. government. European investors, particularly those in Britain, did not simply accept the total loss. They organized, forming creditor committees that constantly petitioned the U.S. government and Congress to intervene. They argued that the U.S. should assume the debt on humanitarian grounds, compensating the innocent middle-class investors who had simply purchased what was then considered a legitimate sovereign security. The legal argument. Creditors argued that the money had been used to acquire essential war material now incorporated into the American economy, suggesting the U.S. benefited from the acquired assets without paying the debts incurred to acquire them. The moral argument. They stressed the unfairness to small investors, arguing their repudiation only truly hurt individuals, not the large banks who could absorb the losses. The U.S. government, however, steadfastly refused, assuming the debt would have legally recognized the legitimacy of the Confederacy and, more practically, set a terrible precedent for any state debt assumed during future periods of domestic turmoil. The financial shield, the U.S. refusal to pay, was a powerful demonstration of sovereign financial power. It was the ultimate assertion that a successful sovereign body, the Union, is not obligated to honor the debts of a failed rebellion. This principle had a profound, if subtle, effect on the future of U.S. foreign debt. It sent a clear signal to global capital markets that U.S. state and federal debt was strictly defined by constitutional law, and investment in politically dubious entities would not be protected by Washington. The financial shield created by the 14th Amendment was ultimately a necessary, if brutal, tool for asserting national unity and stability over international financial concerns. A debt repaid in development. The repudiation of the debt meant that the Confederate states were forced to confront a reality that lasted well into the 20th century. They would rebuild on their own resources, or not at all. The resulting lack of capital meant the South lagged behind the industrial North for generations. It created a cycle of low investment, low wages, and reliance on agriculture that cemented the region's economic difference from the rest of the nation. The financial destruction of the 1860s laid the groundwork for the economic struggle of the Jim Crow era. The debt was never repaid. The bond certificates today are worth only pennies as collector's items, a physical relic of a monumental financial gamble that ended in total, devastating failure. The legacy of the cotton bond is not measured in dollars, but in the enduring shadow it cast over the economic development of the post-war South. I'm John, and this is the Cinematic History Tales channel. Subscribe now to stay ahead of the curve, because when the history books are written, you'll want to be among the few who saw that the final price of the Civil War was paid not in gold, but in the permanent repudiation of the South's most powerful economic weapon.